What's up, everybody? And today I'm going to simplify ICT's silver bullets strategy. So, what is the silver bullet strategy? Okay, it's a strategy that's revolving around fair value gaps, time, and liquidity. All right, there are three technical three technical silver bullet windows, which is the London Open at 3 to 4 a.m., then the New York Open, which is the 10 to 11 a.m., and the New York PM, which is 2 to 3 p.m. Okay. But most traders, including myself, usually when I'm trying to looking for this setup, is looking for it during the 10 to 11 a.m. slot, because that's where the best setups form for NASDAQ, right? So here, I'm going to give you everything that you need for it, okay? What do you need? You need the time. You need 10 a.m. to 11 a.m. Why is that? Because that's a new 4-hour candle open, a new 1-hour candle open, and you drop all the 9:30 open volatility, right? All the nonsense, and it goes like this. Drop all that. Now it's clear price actions and clear skies for you. What do you need? A liquidity sweep on a higher time frame low usually. The higher time frame, the better, okay? So if you're sweeping let's say you're bullish, but you're sweeping a 15-minute low or hourly low, 4-hour low, it's very good. You could be sweeping a 5-minute low though. So that's important to understand. The thing that I will say though that I have noticed for myself is that the higher time frame low, the higher fair value gap you'll be looking for. Okay, so let's say you're sweeping a 4-hour low, a 5-minute fair value gap might be what you're going to be looking for. Whereas if you're sweeping a 5-minute low or a 15-minute low, a 1-minute fair value gap will do the trick. Okay. Not fair value gap. Fair value gap, I have a Smart Money Academy on it if you want to check it out if you don't know what it is. But pretty much it's three candles that form an imbalance in the middle where the wicks of the candles do not meet. Now, what do you want? You want price to return to your fair value gap. You want the price to come back to your imbalance. Okay. Once when that happens, you can set your entry, and your target is at the liquidity, the nearest liquidity, the swing high, swing low, or a 1.5 R minimum. And why did I put that in? It's because sometimes your stop loss is going to be bigger. I usually put my stop below the fair value gap if I'm going to be taking that trade, but sometimes you might get wicked out, so it's also good to put it lower. Now, what I've been doing recently is I've been putting my stop below OTE of that leg. Okay, I'm going to show you in a second. Now, bonus confluence is a higher time frame bias, obviously a draw on liquidity. I usually do not take the trade if I don't have these two. Okay, any trade for that matter. And an S&P divergence is big. This is the best one you could get. So right here, I put you guys a little example. Okay, so you're in an uptrend. Market starts dilly-dallying right around here, and then bang, 10 a.m. opens, and it sweeps this 15-minute low right here that I'm circling. Okay. Now, on the price leg, where there's a displacement, the move that breaks market structure, I missed that here, but this displacement leg right here, and a fair value gap is created. Now, that's your entry, okay? Displacement shows that the market wants to go higher to your drawn liquidity, and you've just swept the low in the times for the ICT silver bullet, okay? Now, what is important here is what I told you guys before. I put the Fibonacci retracement here on the displacement leg. And where is my stop? Below OTE. Not here at OTE. I don't like that. I put it slightly below it like this. Okay, so this trade would be a 1.6 RR, which is fine. Okay, people preach a 5.6 Rs. 1.5 R is perfect. This is a 1.65. That's fine. Okay, with a 1.3 R, you could have a 50% win rate and be profitable. So make of that what you will. So you sweep your 50-minute low, price comes back to equilibrium, goes into your fair value gap, you enter right here, bang, TP hit. Okay, so this is pretty much the ICT silver bullet. Now this is a real chart example that I decided to pull up for you guys. So you have your sell side liquidity right here, which is the London low, as you can see right here. Sweeps the low, breaks back above with displacement. Okay, your displacement ends right here. Why? Because your significant high, which is right here, got breaking through. Okay, and then price comes back to your fair value gap right here. Enter on the fair value gap. Where would the stop loss be? Put the Fibonacci retracement all the way to your leg. The leg high would be here, right? Because this is where your displacement happened. Stop loss would be right here. Take that out now. And this is an easy 1 to 3 R to the top liquidity here. I put break even here because this would be a 1 to 1.74, which is a perfect trade. You could take your TP right there if you wanted this high. Okay, but if you're more confident in the trade and your drawn liquidity and your bias and all that, you could put your trade higher and just trail your stop. Okay, so right here, your stop goes BE. Once market shows the displacement here again, goes back higher here, you could put your stop right I'm gonna move this line here is going to be your stop, okay? You could put your stop right here below this low. And then once this displacement happen here, you could put it right here. And then when this little sweep happens and it moves higher again, you could put it right here. And then your final TP gets hit right here, okay? So I'm going to say it again, guys. You need the time, you need a liquidity sweep, you need displacement. That's really important. You need a higher time period bias and you're drawing liquidity. That's very, very good. And fair value gap has to be created, hopefully, in discount of the range, which is below 50% of the price leg, okay? You enter on the fair value gap, stop loss below OTE or at the swing low, okay? Or below the fair value gap, depending on your risk to reward and your how the market's moving. And then your target is the previous liquidity, previous high, swing lows, higher. You can have no target if you want to just let the price rip. Sometimes that's what happens. Like here in this trade, for example, price just kind of like goes crazy. So you can kind of just trail your stop until you get stopped out in here. You probably end up getting stopped out around here because that's where the deepest retracement is. And other than that, guys, I think that pretty much sums up ICT Silver Bullet. So master this one setup, guys, and you'll see how great it is. Give you guys a little homework. Just go in your charts, check out 10 to 11 a.m., mark it out, and right here, like 10 to 11 a.m. is here to here. Mark out your liquidity sweeps right here. It happens at 10:45, 10:46, I guess. No, 10:45. And yeah, just look how price reacts. Look how you would enter the trade. Go back and market replay. So mastering this one setup, and you'll stop over trading as well is really good. I break down a lot more ICT concepts in my free academy, Smart Mini Academy. There's a lot more coming to the channel as well. I recently broke down the PO3 and AMD setup on the 10 a.m. candle, so go check that out. Check out my YouTube, join my Discord. It's free. All links are in the bio. You get the free ebook, get the free trading journal, all that good stuff in there. All good sauce. I also live trade every single morning. And follow me on TikTok and Instagram, and I'll catch you guys in the next one. Peace out.